How to start investing in the UK as a beginner. Starting your investing journey can feel overwhelming. But in the UK, it's easier than ever to get started, even with a small amount of money. With the right tools, knowledge, and mindset, you can grow your wealth over time and build a strong financial future. Let's break down everything you need to know to start investing as a beginner in the UK. Understand what investing means. Investing is the process of putting your money into assets that can grow in value over time. This could include stocks and shares, bonds, funds like index or mutual funds, real estate, commodities like gold. The main goal of investing is to earn a return. Unlike saving, which usually involves keeping money in a low-interest bank account, investing aims to help your money grow faster, though it comes with more risk. Set clear financial goals. Before investing, ask yourself why you want to invest. Clear goals help you choose the right strategy. Some common goals include saving for retirement, buying a home in the future, building wealth, earning passive income. Once you know your goal, you can decide how much risk you're willing to take and how long you want to invest. Build an emergency fund first. Before you invest any money, make sure you have an emergency fund. This is cash set aside in a savings account for unexpected costs like car repairs or job loss. Aim for at least 3 to 6 months worth of expenses. This way, you won't need to sell your investments at a loss if something urgent comes up. Know your risk tolerance. Every investment carries some risk. Some are riskier than others, but they may also offer higher returns. Your risk tolerance depends on your age, income, financial goals, personality. If you're younger, you can usually take more risk because you have time to recover from market downturns. If you're closer to retirement, you might want safer investments. Learn the basics of investment types. Here's a quick guide to common investment options in the UK. 1. Stocks, shares. Buying shares means owning a piece of a company. If the company does well, your shares may rise in value. You may also receive dividends, which are a share of the company's profits. 2. Funds. Instead of buying one stock, you can invest in a fund that holds many different stocks or assets. There are two main types. Index funds track a market index like the FTSE 100. Mutual funds, actively managed by a fund manager who chooses the investments. 3. Bonds. Bonds are loans to governments or companies. In return, you get regular interest payments. They are generally less risky than stocks, but also offer lower returns. 4. Real estate investment trusts, REITs. REITs let you invest in property without buying buildings. They're traded like stocks and often pay regular income. Choose the right investment account. In the UK, there are several types of investment accounts you can open. 1. Stocks and Shares ISA. This is a tax-efficient account. You won't pay any tax on your profits or dividends. As of the 2024-25 tax year, you can invest up to £20,000 per year in an ISA. 2. General Investment Account, GIA. No annual limits, but you may pay capital gains tax or dividend tax if your profits exceed the tax-free allowance. 3. Pensions, e.g., SIPP. A self-invested personal pension lets you save for retirement with tax benefits. You can't access the money until at least age 55, rising to 57 from 2028. Use a reliable investment platform. You need an investment platform or broker to start buying assets. Some popular options in the UK include Vanguard, Freetrade, Hargreaves Lansdown, AJ Bell, eToro. Compare fees, available investments, and ease of use before choosing a platform. Some platforms offer commission-free trading, while others charge for each trade. Start small and stay consistent. You don't need thousands of pounds to begin investing. Many platforms let you invest with as little as £1. A great strategy is pound cost averaging. This means investing the same amount regularly, like £100 per month, no matter what the market is doing. Over time, this reduces the impact of market volatility. Diversify your portfolio. Diversification means spreading your money across different assets to reduce risk. Don't put all your money into one stock or sector. For beginners, a low-cost index fund that tracks the FTSE 100 or global index is often a good choice. It offers built-in diversification with lower risk. Watch out for fees. Investment fees can eat into your returns over time. Look out for platform fees, charged by your broker or platform. Fund fees, ongoing charges within mutual or index funds. Trading fees, cost to buy or sell assets. Low-fee platforms and index funds are ideal for beginners. Stay invested long-term. Investing works best over the long term. The market will go up and down, but if you stay invested, you give your money time to grow. Avoid checking your portfolio too often. Reacting to every market move can lead to emotional decisions and losses. Learn as you go. Investing is a lifelong skill. Take time to read books, listen to podcasts, or watch videos about personal finance and investing. Some beginner-friendly books include The Little Book of Common Sense Investing by John Bogle, The Psychology of Money by Morgan Housel, Your Money or Your Life by Vicki Robin. Also, websites like Money Saving Expert, Which, and The Motley Fool UK are great resources. Avoid common mistakes. New investors often fall into traps. Here are a few to avoid. Trying to time the market. Chasing hot stocks or trends. Investing without understanding the risks. Borrowing money to invest. Pulling out during market dips. Keep your emotions in check and stick to your plan. Consider getting advice. If you're unsure where to start, you can speak to a financial advisor. Make sure they are regulated by the Financial Conduct Authority, FCA. They can help you build a tailored investment plan based on your goals and situation. Final thoughts. Starting to invest in the UK as a beginner doesn't have to be complicated. Begin with clear goals, set up a safety net, and use simple tools like ISAs and index funds. Focus on learning, consistency, and long-term thinking. Remember, the best time to start investing was yesterday. The next best time is today.